let's look at basic investment appraisal. All of this is what you'll have seen previously within F9. But as we said in the introduction video right at the very start, it's vitally important that you know your F9 knowledge well to be able to do well within P4. So what we've got are the 4 investment appraisal techniques that we've seen before: NPV, IRR, ARR, and Payback. What we're going to go through and do is look at each one of those individually, and as we look through them, we'll work ourselves an example to make sure that you're comfortable with the numbers that you see. So, first technique that we're going to go through and look at there is your accounting rate of return, your ARR. Quite simply, all it goes through and does is calculate a percentage return based upon the amount of investment that you have invested within your business. It simply calculates a percentage. In terms of how that goes through and helps us make a decision as to whether we accept or reject a project, we will accept the project if our accounting rate of return is greater than some predetermined target. However, if that accounting rate of return we calculate is less than some predetermined target, then we will reject the project. There are various pitfalls that we have there. One, who goes through and sets the target that we are trying to beat in terms of this investment appraisal technique. So it could be quite easily manipulated to ensure that we take on board the project. And what we'll see as well in a moment is that it's very much based upon profits as opposed to cash flows. Remember, profits don't necessarily equal cash. So let's look at how we calculate your ARR. We've got 2 formulae based upon different ways of calculating your accounting rate of return, neither of which you'll be given in any formulae sheet within the exam. Why? They are very, very straightforward. So, first of all, our first ARR calculation is going to be based upon what we refer to as your initial investment. So what we look at is your average annual profits, so after charging any depreciation. So what we may have to do is take a cash flow and adjust that cash flow for any depreciation to get back to a profit figure, and divide that by your initial capital cost. Multiply that by 100% to give you your ARR as a percentage, which can then be compared to your predetermined target as to whether we accept or reject the project. Other alternative method, which is again a bit of a downfall of ARR, and that we have alternatives for the calculation, is that the second way of calculating your ARR is based upon what we refer to as an average investment. How do we go through and calculate that average investment? Well, that quite simply goes through there and takes your initial cost plus any working capital required, so any extra working capital that we need for this project, plus any scrap value that we may get from selling the asset at the end of the project, and we then just divide that by 2. Again, not given within the formula sheet, something you need to commit to memory. It may be a good idea, even at this early point within the syllabus and the course, just to go through and make yourself a separate formula sheet, something that you can use and revise from as you go through the course. But first of all, let's go through and have a look at an example. So if we look at this example, what we can see is that we have there a project of 5 years. This project has potentially 2 different options. We have project 1, we have project 2, and each of those projects are mutually exclusive. What do we mean by that? Well, we can either do project 1 or we can do project 2. We can't do a combination of the 2 projects. If you like, we can only choose one of those projects. We're going to go through and appraise these 2 projects, looking at our accounting rate of return. And the information that we are given is in project 1, we have annual cash flows of 200,000. It costs us 556, and we can sell the asset at the end of 5 years for £56,000. For project 2, we have annual cash flows of £500,000 for each of the 5 years. We could buy the asset for £1.616 million at the start and then sell it for £301,000 at the end of the project's life. Other bits of information we are told further down, we have got there a straight line method of depreciation, so we're going to charge equal annual depreciation expenses in each of the 5 years. So, because we are given the scrap value of the asset at the end of its life, we're going to go through and calculate your accounting rate of return for each of the projects. So for project 1 and then project 2, based upon our average investment. So what we'll have to do is we'll have to calculate 2 things. We'll need to work out our average annual profit, and what we'll also have to calculate as well is our average investment. Now, it's usually easier to calculate your average investment before looking at your average annual profits. So for project 1, what we have there is we went through and we bought the asset originally for £556,000. We could scrap it at the end of its life for £56,000. If we divide that there by 2, that gives me an average investment of £306,000. In terms of calculating your average annual profits, what we're going to go through and do is we're going to look at our total profits for the 5 years and then divide those total profits by 5 to get us there our average annual profit. So to be able to do that, first of all, we're going to calculate our total cash flows. So we have 5 years that generates us £200,000 per annum, generating us £1 million. From those cash flows, we need to convert that into a profit figure, which will mean deducting some depreciation. So what we're going to go through and do there is deduct from our total cash flows our total depreciation. Now, we're not specifically given the depreciation figure, but we can calculate it. Because if you go back to the definition of depreciation, we depreciate our asset from its initial cost down to its residual value over the life of the asset. So we bought it for £556,000, we sold it for £56,000, so we will have charged £500,000 worth of depreciation over the 5 years. To work out our total profit, that's just going to be there, the £1 million, less the 500,000, giving me total profits of £500,000, which we can then work out our average annual profit, which is there as 500,000 divided there by 5. So it gives me there £100,000. So there, what we've then got now is we've got our average annual profit of 100,000. We've got our average investment of 306. So we can then go through and account for our accounting rate of return, which is there as 100,000 average annual profits, divided by 306,000 as your annual investment. We'll go through there and give us a percentage. 32.7%. And what we can go through and do there is compare that to a predetermined target. So if you like, we can go through and compare that to our company cost of capital, our company discount rate, Shareholders within this question required a return, was it there, of 15%? So therefore it beats that predetermined target, so we would accept project 1. However, we need to compare that to project 2 to see which of the 2 projects we would choose over each other, project 1 or project 2. So what I'd just like you to do, based on what we've just seen there, have a go and work it out for project 2, calculating your accounting rate of return based upon your average annual profits. So how did you get on for project 2? Did you get an answer of 24.7%? Yeah, good. If you got 24.7%, feel free to skip over the next couple of minutes and start looking then at your payback period. However, if you made a mistake, let's just go through and ensure that you know where you went wrong. This is the basics, you need to be happy with it. So what we've got there, if you look at your average annual profit, we made £500,000 per annum for 5 years, so 2.5 million, giving you your total cash flows. Your total depreciation is bought it for 1.616 million, sell it for 301,000, gives you their total depreciation of 1315. Total profits of 1185,000 as you take your depreciation from your cash flows, which goes through there and gives us an average annual profit of £237,000. In terms of your average investment, you take your initial cost plus your scrap value divided by 2, should give us there 958,500. And as we said before, your accounting rate of return should work out at 24.7% as we go through there and do your 237 divided by 958,500. Simples. The next investment appraisal technique that we're going to go through and look at is looking at your payback period, possibly the simplest of all the techniques. All we're looking at there in terms of an idea is how quickly we get the cash back from our initial investment. So ARR before was looking at profits and looking at a percentage. Payback is now looking there at cash flows, looking not at percentage but in terms of a number of years. And the quicker we get the cash back, the better. If you're looking there in terms of a decision rule, if your payback period is less than a predetermined target, so you've got your cash in quicker than you expect, you'd accept the project. If, however, your payback period is longer than your predetermined target, you would reject the project. Again, we have that issue in terms of who sets that predetermined target, but let's not worry about that and let's just go through and look at the same example as what we had before. So, same example, same 2 projects. We're looking at your payback period. How quickly do we go through and recover our initial investment in terms of a number of years? So what we have, we go through there and look at project number 1. The way we look at it is a 3-columnar approach like you've seen there within F9, your financial management. Because in project 1, what we had there is at T0, we had a cash flow which was there, an initial investment of 556,000. So we'll just work in round thousands. So my net cash flow at T0 is there at 556. In T1, we go through there and receive cash of 200,000. Well, based upon the fact we've already spent 556, that now means that my net overall cash flow is negative 356. What we're trying to look at now is when that cash flow goes from a negative to a positive cash flow. Again, T2, we get £200,000, so my net cash flow is now there at 156. And then T3, we receive another £200,000, which gives us there a now positive cash flow of £44,000. So what we have is our payback period is somewhere in between T2 and T3. And what we go through and do is assume that the cash flow that we receive of £200,000 accrues evenly throughout the year. We could make the assumption that the cash flow arises at the end of the year, in which case we receive £200,000 at the end of year 3 and therefore a 3-year payback period. However, that's a bit too basic. We'll assume there that the cash flows accrue evenly over the life of the project. So, how do we go through then and work out our payback period? Well, it's 2 years, and we then need to assume that we get £156,000 over the year, whereby we got a full £200,000. So there we have, based upon my calculations, 2.78 years. Again, same as what we did before. Have a go, work it with project 2 and see how you get on. So, how do you get on? Do you get 3.23 years? If so, great, move on. If not, where did it go wrong? So as you can see there, we have our initial investment at T0, our series of constant annual cash flows of £500,000, and you can then see that that net cash flow reduces by the £500,000 every single year. When we get to the 3rd year, we then get cash flows in the 4th year that change it from a negative net cash flow to a positive net cash flow. So it's there 3 years and a little bit more than 3 years. So we need to go through and get £116,000 back in that final year. We generate £500,000 worth of cash in the entire year. So 116 divided by the 500 gives us that extra 0.23 years. Again, nice and straightforward. The third technique that we're going to look at is, if you like, possibly the most important technique of them all. Is looking there at your net present value. You saw NPV in huge volumes there within F9. Let's just go through and recap. It's key, takes account of cash flows, goes through there and takes account of discounting. So we need to discount those future cash flows back to present value. If we have a positive net present value, then we accept the project. A negative NPV, we will go through and reject the project. Before we go through and start looking at any examples and refreshing you with it, let's just go through and look at some discount factor formulae. Because what you've got, if you've got a single cash flow that arises within any given year, then your discount factor at time period n is 1 over 1 plus r to the power of n, whereby r is your discount rate and n is the number of years. If you have an annuity cash flow, so a series of constant annual cash flows starting in a year's time, so at T1, and lasting for several years up to Tn, then your annuity factor formula is 1 over your discount rate multiplied by 1 minus 1 over 1 plus your discount rate to the power of n. Finally, your perpetuity factor formula. So a series of constant annual cash flows starting in a year's time, lasting to infinity, so going on forever and ever and ever. We have there 1 divided by your discount rate. Remember, the reason why we have these different formulae is so that we can go through and work out your present value as your cash flow multiplied by your discount factor. So when we're looking there at your cash flow, we'll need to go through, like we saw in F9, look at our relevant cash flows, and then there our discount factor needs to look there at a discount rate that incorporates interest, inflation and risk. We're going to go through at the moment to look at interest. We'll recap a little bit on inflation shortly, and then we'll see a lot of risk as we go through and work through the syllabus. So let's go through and have a look at the example that we've been working on the previous scenarios. So using this same example that we have here, we're going to look at project 1, we're going to look at project 2, look at how much we invest, how much we get at the end of the project in terms of the scrap value, and then also look there at the annual cash flows that we receive for projects 1 and 2. We're then going to go through there and use that discount rate of 15% to work out our discount factor. Key thing that we have here within this example is that project 1 has annual cash flows of 200,000. Project 2 has annual cash flows of £500,000. So what we have here is an annuity. Also what we have as well is that those annual cash flows arise on the anniversaries of the initial outlay. So the initial outlay is at T0, so the cash flows will start at T1 and go on to T5. And what we're also told as well is that there are no price changes, and we're to go through there, ignore tax, and also the projects will not alter the working cash capital. So there's no change in your working capital figure. So we can ignore tax, we can ignore inflation, we can ignore working capital. So let's go through, have a look at these annuity cash flows for Project 1 and Project 2 and see how we get on. So in terms of Project 1, at T0, we go through there and invest £556,000. Discount factor at 15%, well at T0, that will always be there, a discount factor of 1. We then have T1 to 5, we get constant annual cash flows of 200,000. T5, we then scrap the item for £56,000. We need an annuity factor there for 5 years at 15% and a discount factor for 5 years at 15%. So my annuity factor at 15% for 5 years is 3.352. So you can look that up within your tables. And then there, your discount factor is there at 0.497. So what we have there is your annuity factor from 1 to 5 at 15%. And then there, your discount factor for T5 at 15%. If I multiply my cash flow by my discount factor to get me my present value, bit of rounding, I've got 670,000, 28,000, and then there, when I net it all off, I have 142,000 as a positive NPV project. Again, same as before, have a go and see if you can work the NPV for Project 2. So, did you get £210,000? Brilliant. If not, don't worry. Let's just see where you may have gone wrong. So what we have there is our initial investment of 1.616 million at T0. Present value 1.616 million. You've got then your constant annual cash flows of £500,000 for each of years 1 to 5. And we multiply that by exactly the same annuity factor that we had in Project 1. An annuity factor from 1 to 5 there at 15%. Also, at the end of the project, we scrap the asset for £301,000, discount it back by a discount factor at T5 at 15%, will give you then your present value. When you then total up all of those present values to give you your net present value, that should give you the £210,000. The final discounted cash flow technique we're going to go through and look at is looking at your IRR, your internal rate of return. Quite simply, the idea behind it is to try and look at a discount rate that gives us a nil net present value, if you like, a break-even discount rate. Because what we can then go through there and look at is how that would appear if we were to plot the IRR for a given project. Now, we should have gone through and seen previously our diagram drawn up where we plot the net present value down the side against your discount rate. And as we go through there and increase the discount rate, we reduce the present value of the cash flows. So therefore we are reducing the net present value. So we should have a slope that starts in the top left-hand corner and steadily decreases your net present value as we increase the discount rate. What we then have there is where that line crosses the discount rate axis, that there is your internal rate of return. How do we go through and calculate that point? Well, the way in which we go through and solve for the internal rate of return is what's referred to as linear interpolation. It's an estimate. It's not an exact science, because all we go through and do is use two guesses at a discount rate to calculate a net present value for each. And then once we've plotted those 2 points on our graph, we need to linearly interpolate between the two to work out what the IRR is. You've seen it before, so it should be familiar. So what we have there, let's just call our first guess RA, so the first discount rate that we've made a guess at, and we'll call that a point which gives us a net present value at point A, so NPV-A. We'll then go through, increase our discount rate to try and reduce the present value of the future cash flows and get a more negative NPV. So we'll refer to that point there as RB, and that will give us a corresponding NPV at point B, which we'll call NPV-B. Once we've gone through and done that, we can then go through and work out our internal rate of return. Our IRR goes through there and takes our first guess at discount rate A. Then we add on NPV-A divided by NPV-A minus NPV-B multiplied by RB minus RA. Because what that formula should go through and do is give us a straight line between the 2 points, so that what we then calculate is this point there, which in effect, it's not a diagram drawn to scale, it's only very rough, but that point there that we've approximated via linear interpolation should be pretty close to your internal rate of return. You need to remember that formula that we have there for your linear interpolation. It won't be given to you within the exam. So let's go through and carry on working the example that we've been looking at for our previous investment appraisal techniques. So looking at project 1 and appraising it via IRR, what we have so far is we've done an NPV calculation before based upon a cost of capital of 15%. That gave us a positive NPV. So what we can go through and do is, based upon our first discount rate of 15%, giving us a positive NPV of 142,000, we can go through then and increase the discount rate to try and reduce the NPV and to try and take it negative. So what we'll go through and do is we'll say there that RB is at 20%. And we can go through then and calculate a net present value for discount rate B at 20% and then linearly interpolate. So let's go through, use 20% as my discount rate to work out my NPV. So my time period, cash flow, discount factor at 20%, and then there your present value. So what we have there, T0, for project 1, we had an investment of 556,000. Discount factor of 1 at T0 give me a present value of 556,000. T1 to 5, we had annual inflows of £200,000. If we look now at an annuity factor for 5 years at 20%, from your tables that should be 2.991. Giving me their present value again, a little bit of rounding gives me 598. At T5, when we sold the asset, we sold it for £56,000. It's there at 0.402. As your discount factor at T5 at 20% gives me there a present value of 23. And when I total everything up, it gives me an NPV of 65, which unfortunately is positive. So what is that telling me? Well, it's giving me a positive NPV of 65,000, which means ideally my guess for my second guess at my discount rate should have been a bit higher than 20%. Maybe 21, 22, 23, 24, 25%. But we're not going to go through and change anything. We'll just work with the numbers that we've got. What it will mean is that my calculation of my IRR is just ever so slightly inaccurate. But at the end of the day, it's not an exact science that we are calculating, it's a guess. So what we're going to have now is your internal rate of return. So that goes through there and takes my first discount rate, so RA at 15%. Then we add on NPVA divided by NPVA minus NPVB multiplied by the difference between the discount rates. Again, you should be familiar with calculating this from your previous studies, but I calculate that part of the fraction first and then go through and add on the 0.15. If you tap that into your calculator, it should work out at 24.2% as your internal rate of return. So how do we go through then and use that as a decision-making tool? Well, if we look at the diagram that we were playing around with before, what we have there in terms of our decision is the fact there that your IRR we have calculated at 24.2%. And this company had a discount rate, a cost of capital at 15%. So if you like, your discount rate was there to the left of your internal rate of return. Your discount rate for the company was less than the IRR. Now, based upon what we have there, that's going to give us a positive NPV. Anything to the left of our IRR has a positive NPV figure. So therefore, our decision-making tool is that if your cost of capital is less than your internal rate of return, you will accept the project. So there, we will accept. However, if it was to the right of your IRR, we would go through there and reject the project. So your cost of capital greater than your IRR, we would reject. Here, we'd accept the project, but we need to look at project 2 first before we make any decisions between projects 1 and 2. So, as we've done before, have a go, project 2, see how you get on. So, how did that work out? What we had from the first guess that we had at 15%, we had an NPV of £210,000. And then what we're going to go through and do, let's be consistent with what we had before. We'll look at a second discount rate again at 20%. You need to go through then work out the NPV at 20%, which, based upon what we have there, discount rate at 20%, giving me a 5-year annuity factor of 2991, giving me there a discount factor at 5 years at 0.402, gives you a net present value there of nil. If you add it up, I think it comes to +1, but to you and I, that's pretty much 0. So what we have there is at 20%, my net present value is equal to nil. So if that's the case, your IRR is there at 20%. Again, your cost of capital, 15%, which is less than your IRR, so we go through there and accept project 2.